is there a sense of inevitability that we are headed, agnostic to what markets you're operating in, we are headed in that direction of just more money going into indexing and passive? And what do you think the future is for active?
They are extreme outliers. And it's not that active can outperform. I think it's that on average, active can't outperform. And my friends over at S&P, they put out a fantastic piece every year called SPIVA, which stands for S&P Index versus Active. And what they do with that piece of work is they compare active managers versus their chosen or their closest benchmark. And the punchline of their work, what really sits with me, is that over the long term, over 5, 10, 20-year periods, about 80% of active managers underperform their chosen benchmarks after cost. And I'm a numbers guy, David. And as I bring it back to performance and think about those probabilities and think about an investor looking to make the decision, active, passive, or a bit of both. If they are steering hard towards active, they got to think, hey, 80%, those are my odds of underperforming versus 20%, that much smaller 20% of outperforming. So I think that sticks with me. And I also want to call out persistence is an important thing to look at there too. You say, hey, I'm not going to pick any of those bad managers. I'll just pick some of the good ones or the great ones in that 20%. And as S&P looks at that in their scorecard, there's a whole lot of turnover in that 20%. And the quantity or the amount of active managers that can outperform on a repeated basis is something in the order of 2 to 3%. So again, bringing it back to the odds and where the average investor should be starting their portfolio and building the core of their portfolio, indexing just makes a lot of sense, and it's going to give them a bit of a head start there on the performance side when, again, they don't have a process or an advisor to help them drive towards the right active manager.
Well, I guess my question is, if the odds are stacked up against you, and you do have outliers that tend to have lasting power, like Warren Buffett, for example, and these outliers, to your point, literally have to turn money away. Why do you think people even bother to try and outperform the market? And I guess part of that question too is because you guys also run active strategies. You mentioned that earlier on. So why do you guys even bother?
Vanguard absolutely believes in active. And at the intro, I mentioned Vanguard doesn't want to be thought of as an index manager. We want to be thought of as a low-cost manager. And one of the keys to getting performance after fees right for an active manager is cost. And all investors, so active and index, they've got cost of dealing in the market. Think management fees, salaries, bid-ask spreads, commissions, market impact, and taxes. Those costs can be high, and they absolutely reduce investor returns over time. So, that's a hurdle. And if you're an active manager, you've got to overcome that hurdle to deliver alpha after costs. And again, the higher the cost of active, the higher that hurdle, and you can turn a great active manager, a brilliant active manager, into a bad one simply by raising their fees up too high. So as we think about bringing active and passive together, getting the cost right and getting a talented manager are absolutely key on the active side.
What are the economics of getting Michael Jordan on your team? If he charged you $10 billion a year, it didn't make sense for the Bulls to take him. Anyway, that's just a random tangent. But that's a good point, though. From an internal perspective, is it more expensive to run an active operation than it does a passive, for example?
Yeah, it is. It is certainly more costly to run active than index. And again, if you think about salaries, analysts, data, research, information to feed that, to get that edge on the active side, there's a lot of inputs you need to to have an edge over the market.
What's the edge, though? I mean, we just came from a, sorry to interject, we just came from an exchange there where over time the edge disappears.
It does, David. And I have been doing some thinking with the team here and looking at professionalization of the markets and see some interesting things there with manager skill. And basically, as I talk about professionalization, I want to explain something to the listeners. If we were to break up the market into two camps, let's say professionals, think mutual funds, hedge funds, ETF providers, index managers, those are your pros. And then you've got your non-pros. Think retail managers, ordinary people punting and picking stocks. It's important to remember the financial markets and the equity markets, it's a zero-sum game. So there's no natural source of alpha out there. And for investor A to be above average, investor B needs to be below average. And the total outperformance of the winners must equal the total outperformance of the losers. So with that in mind, when investing, it's really important to know who you're trading against. And you got to ask yourself the question, like, who's on the other side of my trade, and why do I think I have some sort of edge over them? And as we've been looking at some data here in Oz, 50 years ago, our Aussie market and really equity markets around the world, they were largely non-professional. So a lot of retail players and professionals were a smaller segment of the market. And fast forward to today, where most major markets, including Oz, they are dominated by pros. So 90% plus of daily turnover in the market is professional. And if we bring in the derivative markets, that number pushes up to like 98 or 99%. And what's happening there is increasingly the amateurs are shifting to professional funds and index funds. And the easy money, or it's somewhat of a mean term here, but willing losers, they're dropping out of the market. And in essence, the active is getting harder every year because the market is now dominated by professional investors. And again, the big problem for active investors is that edge, like it's pros versus pros, and the markets are getting more efficient and they're getting harder. So would love to touch on skill if this is something of interest as we think about, manager skill and how are they getting that edge and how that's changed over the years.
The late great Charlie Munger on one of those annual meetings, of course, I forget which one, but he said all he has to do is, and I'm paraphrasing, outperform idiots. And he said, thank God that the world is full of them. And I just have to be somewhat just half a step ahead of idiots. So how do I develop skill? First, from an organizational perspective, how do you determine, from a recruitment perspective, who is a skilled manager? And coming up for up and coming fund managers, how do I develop that skill? What is the North Star for that?
Yeah, David, I love the angle of that question. And as I think about skill and increasing skill in the market, there absolutely is a noticeable and material improvements year on year there as things get more and more professionalized. But I might break up skill into kind of two dimensions and think about absolute skill and relative skill. And absolute skill, I think, is where your question's going. And man, it has never been better. And active managers of today, they've got CFAs, PhDs, Bloombergs, data feeds, accounting info, AI, machine learning, better systems, algorithms. And, we talked about performance earlier. I'm like, why aren't the active managers doing better with all that skill and all that technology? And a bit of a paradox here. And the answer is in relative skill. And we were just talking about absolute skill. If we look at relative skill, again, the spread of skill among market participants, kind of going back to the professionals and the non-professionals, that has really narrowed over the years and over the decades. And all investors today are a whole lot smarter. And asset management, again, largely professionalized. A lot of those non-pros have turned to indexing and pros for better results. And the variance in the skill set of market participants has really dropped. And that matters. Again, what active managers want are weaker players introduced back into the market so they can express their skill. And, as I talk to clients about this, I love to use an analogy. It kind of reminds me of my friendly neighborhood poker game. And we get players in there of varying skills. And, the newbies, the ones that aren't educated, aren't sophisticated in playing poker, they get knocked out pretty early. They hand over their cash, they eat some snacks, and they're out of the game. But come midnight or 1 o'clock, it's all the card sharps, and the game gets harder as the evening progresses. And it's like midnight or 1 p.m. in the markets these days. Again, it is largely professionalized, and the game is just getting harder there. So, that's those are some thoughts on skills. And I will say, if we had a time machine and we could go back into the 70s with today's skill set, any of the managers of today would absolutely kill it. But it's again, there's a paradox on the skill side. We can't just look at absolute skill. We need to think about relative skill. And as markets have grown more and more professionalized, that's just one of the reasons why indexing is looking more and more attractive to investors, and particularly novice investors.